Today, we're diving into the latest movements surrounding Boston Scientific, a prominent player in the medical instruments and supplies sector. This afternoon, shares of Boston Scientific slipped by 1.9%. Now, for those of you who are keeping a close eye on the stock market, this might raise a few eyebrows, especially considering the company's impressive 52-week performance, which has seen a change of 19.9%. To put that into perspective, the S&P 500 has only managed a meager 3.3% during the same time frame. So, what's driving the current dip, and what should investors be aware of? First, let's talk about the analysts' take on Boston Scientific. The average analyst rating stands at a solid buy. However, the stock is currently trading about 4.22% below its mean target price of $53.89 per share. This discrepancy could indicate that there's some room for growth, but it also raises questions about the recent market reactions. Are investors getting jittery, or is this just a temporary blip on the radar? Next, we need to look at the earnings picture. Boston Scientific has a trailing earnings per share, EPS, of $0.45, which brings its price-to-earnings, PE, ratio to a staggering 114.7. To put that in context, the average PE ratio for the healthcare sector is 24.45. This means that Boston Scientific is trading at a premium compared to its peers, which could be a red flag for some investors. However, the forward-looking metrics tell a different story. The company's forward EPS is projected at $2.16, leading to a forward PE ratio of 23.9. This suggests a more favorable outlook and could justify the high trailing PE to some extent. When we examine the balance sheet, we find that Boston Scientific has a price-to-book (PB) ratio of 4.2, which is slightly above the healthcare sector average of 4.16. This indicates that the stock is valued at a premium compared to its book value, which can be a sign of strong future growth expectations. But, as always, it's important to weigh these metrics against the company's operational performance. Speaking of performance, Boston Scientific has reported a year-over-year quarterly earnings growth of 56.7%. That's a significant uptick, indicating that the company is not only growing but doing so at a pace that outstrips many of its competitors. However, their gross profit margins are sitting at just 0.7%. which raises some concerns about operational efficiency. It's a reminder that while revenue growth is essential, managing costs effectively is equally vital. Now, let's touch on cash flow, which is the lifeblood of any business. Boston Scientific reported free cash flow of $914 million last fiscal year. But here's the kicker. The average growth rate for free cash flow has been just 9.7%. This decline could signal potential challenges in sustaining that cash flow moving forward, which might worry some investors who rely on consistent cash generation. On the revenue front, Boston Scientific has an average growth rate of 4.3%, while operating expenses are growing at a slightly slower pace of 3.4%. This is a positive sign, as it indicates that the company is managing its expenses effectively relative to its revenue growth. The current operating margins stand at 16.0%, which is respectable but could be improved. So, what does this all mean for investors? While Boston Scientific has shown resilience and growth potential, the high PE ratios, declining free cash flow, and tight profit margins warrant a cautious approach. It's essential to keep an eye on the broader market trends and how they might impact this large-cap company moving forward. As always, do your research, stay informed, and make decisions that align with your investment strategy.